In the annals of finance, few names evoke as much drama and spectacle as Lehman Brothers. A titan of Wall Street, Lehman Brothers' rise to prominence is a story steeped in history and ambition. Our narrative begins in the mid-19th century, in the year 1850 to be precise. Three German immigrants, the Lehman Brothers, Henry, Emanuel, and Meyer, established a modest dry goods store in Montgomery, Alabama. Little did they know, their humble enterprise would evolve into a financial behemoth, influencing the very ebb and flow of global finance. The Lehmans first tasted success trading cotton, a commodity in high demand and short supply due to the American Civil War. Their acumen and reputation grew, transforming their business into a commodities trading powerhouse. The turn of the century saw Lehman Brothers relocate to New York, the epicenter of American finance. Here, they expanded into investment banking, underwriting public offerings for growing American businesses. From the roaring 20s to the post-war boom, Lehman Brothers was at the heart of major financial deals, helping to shape the American economic landscape. They financed railroads, backed airlines, and even had a hand in the creation of television giant CBS. Lehman Brothers was not just a witness to history, but an active participant and shaper of it. As we moved into the latter half of the 20th century, Lehman Brothers continued to innovate, pioneering computerized trading and becoming a leading player in the burgeoning field of mortgage-backed securities. Their name became synonymous with savvy and success, their influence reaching far beyond Wall Street. But with great power comes great responsibility, a lesson that Lehman Brothers would learn the hard way. Their appetite for risk, while often rewarding, would eventually lead them down a perilous path. A path that would test the resilience of not just Lehman Brothers, but the very fabric of the global financial system. By the dawn of the 21st century, Lehman Brothers was a titan of Wall Street, seemingly unshakable. Yet beneath this veneer of invincibility, a storm was brewing, one that would ultimately lead to the fall of this financial giant. But beneath the surface, a dangerous gamble was taking shape. A new breed of financial products, known as subprime mortgages, was gaining popularity. These were essentially loans given to individuals with less than stellar credit, the kind who might struggle to qualify for a conventional mortgage. This was seen as a way to democratize homeownership, to extend the American dream to those previously locked out. Now, these subprime mortgages were risky, but the risk was obscured by a financial sleight of hand. The loans were bundled together into something called mortgage-backed securities, or MBS for short. These MBS were then sold off to investors like Lehman Brothers. The idea was that by spreading the risk across many loans, the danger of any single loan defaulting would be mitigated. In theory, it was a win-win. Lenders could offload risk, and investors like Lehman could rake in the profits from the mortgage payments. But Lehman didn't stop there. They doubled down on this risky venture by investing heavily in an even more complex financial instrument: collateralized debt obligations, or CDOs. These were essentially a bundle of bundles, a myriad of mortgage-backed securities packaged together. Lehman's bet was huge. They were convinced the housing market would continue to rise, that the wave of increasing house prices would carry these mortgage-backed products to new heights. And for a while, it seemed they were right. As the housing market boomed, Lehman's investments in these subprime mortgages paid off handsomely. Their profits soared, their stock prices reached new peaks, and they were hailed as Wall Street wizards. But all was not as it seemed. These mortgage-backed securities and CDOs were, in essence, a house of cards. Each card represented a mortgage, and if enough of those mortgages defaulted, the whole structure would collapse. And with each card that was added, the structure became less stable, more prone to a catastrophic failure. As the housing market boomed, so did Lehman's fortunes. But as we now know, it was a house of cards. It was a gamble, a bet placed on the continued prosperity of the housing market, a bet Lehman Brothers would ultimately lose. In 2007, the unthinkable happened. The housing bubble burst. A cataclysmic event that sent shockwaves through the world of finance. It was the moment when the golden goose of the housing market stopped laying its eggs of gold. The housing market had been on a seemingly unstoppable upward trajectory for years. Home prices had been soaring, and more people than ever were buying homes, many with the aid of subprime mortgages. These mortgages, designed for borrowers with less than stellar credit, had fueled a significant portion of the housing boom, but the boom was not to last. Suddenly, in 2007, the music stopped. Home prices began to fall, and the wave of defaults and foreclosures began. The subprime mortgages, once seen as a ticket to homeownership for many, turned into a nightmare. Borrowers found themselves unable to make their mortgage payments, and the defaults started to pile up. In the midst of this chaos, Lehman Brothers found themselves in the eye of the storm. They had invested heavily in the housing market, betting big on the continued rise of home prices. They were knee-deep in mortgage-backed securities and collateralized debt obligations, complex financial instruments that were tied to the fate of these subprime mortgages. As the housing market went, so did Lehman's investments. With each foreclosure, with each default, the value of these securities plummeted. Lehman's investments began to bleed red, their once profitable gamble turning into a financial quagmire. Suddenly, the firm that had been a giant in the world of finance was on shaky ground. Their assets were tied up in investments that were rapidly losing value, and there didn't seem to be a way out. The once unshakable confidence of Lehman's executives began to waver as the reality of their situation set in. The housing bubble had burst, and Lehman Brothers was caught in the fallout. The firm that had once stood as a symbol of Wall Street's success was now a symbol of its excess and risk-taking. The housing market's decline was turning into Lehman's decline. Lehman's risky bets were turning into massive losses. In a desperate bid for survival, Lehman Brothers sought a lifeline. As the severity of their situation dawned on them, the top brass at Lehman Brothers took drastic measures. They embarked on a frantic search for ways to keep the sinking ship afloat. First, they tried to raise capital. This involved convincing investors to pump more money into the firm, despite the dire circumstances. It was a tough sell, to say the least. Lehman's reputation was in tatters, and the financial world was becoming aware of the ticking time bomb of toxic assets on their balance sheet. Next, they attempted to offload assets. The idea was to sell whatever they could, to bring in much-needed cash and reduce their exposure to the housing market. But again, they ran into problems. The assets they were trying to sell were the very same mortgage-backed securities that were causing the crisis. Many potential buyers were wary of these complex financial instruments. Lastly, they tried to find a buyer for the firm itself. There were some takers initially. Barclays, a British banking giant, and Bank of America, a homegrown behemoth, both entered into negotiations. But these talks quickly broke down. The potential buyers were put off by the sheer scale of Lehman's problems and the risks associated with acquiring such a troubled firm. Each of these desperate measures was met with failure. The attempts to raise capital fell flat, the asset sales were slow and brought in less than expected, and the negotiations with potential buyers ended in disappointment. As the situation worsened, a sense of desperation permeated the firm. The once mighty Lehman Brothers, a titan of Wall Street with over a century and a half of history, was on the brink of collapse. Its leaders had tried everything they could think of to avoid disaster, but their efforts were in vain. But it was too late, the end was near. On September 15, 2008, Lehman Brothers filed for bankruptcy. This single event sent shockwaves through the global financial system. The titan of Wall Street, a firm that had weathered the storm of the Great Depression, 2 world wars, and countless financial crises, had succumbed to the pressures of the subprime mortgage crisis. The news hit the world like a sledgehammer. The sheer magnitude of the bankruptcy was unprecedented. With over $600 billion in assets, it dwarfed any previous corporate failure. The scale was so massive it was almost impossible to comprehend. In the immediate aftermath, there was a palpable sense of panic. Financial markets around the world spiraled into chaos. Stocks plummeted. Banks, once seen as impregnable fortresses of finance, now looked vulnerable. The once bustling trading floors of Wall Street were in disarray, and the mood was one of disbelief. Investors, once flush with confidence, were now gripped by fear. They rushed to withdraw their money, causing a run on the banks. The world was on the brink of a financial meltdown, and the collapse of Lehman Brothers was the trigger. For many, this was a wake-up call. It exposed the fragility of our financial system and the perilous risks taken by institutions that were believed to be too big to fail. Lehman Brothers, once a symbol of Wall Street's invincibility, was now a monument to its recklessness. The days and weeks that followed were filled with uncertainty. There were questions about the future of the global economy, about the fate of other financial institutions, and about the wisdom of the policies that had allowed such a catastrophe to occur. Yet in the midst of this chaos, there was also a profound sense of change. The fall of Lehman Brothers marked the end of an era. It was a harsh lesson in the dangers of unchecked financial speculation and the perils of excessive risk-taking. In a matter of months, a Wall Street titan had fallen. But its fall served as a stark reminder that no institution, no matter how powerful or prestigious, is immune to the forces of financial gravity. The fall of Lehman Brothers sent shockwaves around the world. This marked the beginning of a global financial crisis, the likes of which had not been seen since the Great Depression of the 1930s. Banks worldwide found themselves entangled in a web of bad debts and risky financial products, leading to a near collapse of the international financial system. In a desperate attempt to prevent a total meltdown, governments around the globe stepped in. In the United States, the Troubled Asset Relief Program, or TARP, was launched. This involved the government buying troubled assets from banks to stabilize them and prevent further fallout. An enormous sum of $700 billion was pumped into the economy to resuscitate the dying financial sector. But the effects of the crisis were felt far beyond the world of banking and finance. Millions of people lost their jobs and their homes as economies worldwide went into recession. The crisis exposed deep flaws in the financial system and led to calls for stricter regulations. In response, the US Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This legislation aimed to reduce the risks in the financial system by increasing transparency, ending too big to fail, and protecting consumers from abusive financial practices. It was the most comprehensive financial regulatory reform since the Great Depression. Yet, the legacy of Lehman Brothers' fall is still felt today. It changed the financial landscape forever, leading to the rise of new financial technologies and a shift towards a more cautious approach to risk management. It also underscored the need for financial literacy, as the complexities of the financial world were laid bare for all to see. The fall of Lehman Brothers serves as a stark reminder of the risks inherent in the world of finance, a lesson we must never forget. It's a testament to the importance of sound financial practices and the devastating consequences when they're ignored. The story of Lehman Brothers is not just a tale of a bank's fall, but a lesson in the interconnectedness of our global economy and the need for vigilance in maintaining its health.